Supply and demand, an area in the market where price is likely to stall and reverse. Supply and demand is a famous economic concept popularized by Adam Smith in 1776, and now it's used by traders all around the world when trying to predict the markets. Supply and demand has gone viral recently as a way for traders to profit off big banks making moves in the market. Supply zones are areas where a large number of sellers are waiting to sell off shares of a stock, and similarly, a demand zone is an area on the chart where a large number of buyers are waiting to buy a stock. When price hits a supply zone, it stalls or drops, and when price hits a demand zone, it stalls or rises. Supply and demand zones can be used to spot potential market entries and reversals. All big banks, hedge funds, and smart money institutions all have an average price they're willing to buy or sell a stock at. When price reaches these areas, these large institutions start to enter the market, and since there's not enough liquidity in the market to fulfill their orders, these orders will remain open but unfilled. And as traders, we can use these unfilled orders to our advantage and trade alongside these large institutions in the future. Before we can do that though, we need to understand how to find these supply and demand zones. They are formed when price shoots up or down after reaching a certain level. You can mark out these zones on your chart and use them for future reference by looking for these two things. When spotting a demand zone, you want to look for an area on the chart where 3 large consecutive green candles formed, following a red or bearish candle. You can then draw your zone starting from the bearish candle's low to the bearish candle's close and extend the zone. Spotting a supply zone is the exact opposite to finding a demand zone. Look for an area on the chart where 3 large consecutive red candles formed, following a green or bullish candle. You can then draw your zone out from the bullish candle's high to the bullish candle's close and extend the zone. Now that you have these areas on your chart where large buyers and sellers have interest in the markets, you can start to look for some trades. When looking for a long trade, you want to wait for price to enter your demand zone and respect it. This means price doesn't break below the zone, but rather it bounces off of it. If this happens, the demand zone is likely to play out and you can enter the market long. You'll set a stop loss below the zone and take profits at the nearest supply zone. And when you're looking for an opportunity to short the market, you want price to come up to your supply zone and respect it. If this happens, you can enter a short position, set your stop loss above the supply zone, and your take profits at the nearest demand zone. Remember though, just like anything else in trading, these zones aren't going to work 100% of the time, so it's best to pair other forms of technical analysis with them for the best chances of success. Zones drawn on higher time frames, such as the 1 hour and 4 hour, tend to be stronger, so it's important to have supply and demand zones on multiple time frames so you don't miss any important market levels and take a bad trade. Luckily, the FluxChart's multi-timeframe supply and demand zones indicator automatically plots these zones on several timeframes, and it also alerts you when price is entering them, so you don't miss any market reversals or winning trades. You can try it out for 7 days risk-free in the link in my bio.